Hello and welcome to Stockwatch Live. Now, after the onslaught of companies reporting last week, the week ahead is a very quiet one. Of note, though, is HSBC, with half-year figures due out on Tuesday. At the last count, it revealed that a strong performance from its Asian division and tighter cost control had helped it post a 31% rise in first quarter pre-tax profits. At $6.2 billion, they came in above expectations from UBS, which had penciled in $5.7 billion. The bank's Common Equity Tier 1 ratio, which is a key measure of its financial health, was up 30 basis points to 14.3%, but its net interest margin, which is the difference between interest earned on loans and money paid on deposits, slipped to 1.59% for the quarter, missing UBS's estimate of 1.66%. However, things do appear to have been picking up for HSBC, so Tuesday's results, which complete the full set from the banking sector, may be a case of leaving the best to last. But then again, maybe not. That's because the bank has recently announced it'll be extending its compensation scheme for customers who were charged unreasonable debt collection fees. So far, so standard, you might think. But the problem here is that almost 4 times as many people as originally thought may be due compensation, and that, of course, could cost it. The financial services regulator, the Financial Conduct Authority, said it expected HSBC to pay around £4 million in compensation. If the new customers have to be compensated at the same rate, it would cost the bank a further £11 million. The company started compensating former customers of its John Lewis Financial Services and HFC Bank subsidiaries in 2017 after an investigation by the FCA. The bank initially estimated around 6,700 customers could be entitled to redress, but it's now writing to an additional 18,500 who hadn't previously been contacted. Brokers are, not surprisingly, cautious. There have been a flurry of downgrades. Jefferies International has gone from buy to hold and cut its price target from 850 to 691 pence. UBS remains neutral but has cut its price target to 633 pence. Barclays Capital has downgraded to underweight and cut its price target by 140 pence to 600 pence, while Deutsche Bank says the shares are a straight sell, but has raised its price target to 540 pence. We haven't heard much from the hotel sector of late, so also of note will be half-year figures from InterContinental Hotels on Tuesday. The group, which owns the Holiday Inn chain, has seen its biggest expansion in room numbers for a decade over the past year, as it positions itself to capitalise on opportunities in the luxury sector and counter slowing sales in its main US market. It's expanded through a series of big acquisitions and brand launches, including taking a 51% controlling stake in Regent Hotels and Resorts for $39 million and buying luxury resort company Six Senses from Pegasus Capital Advisors for $300 million. It also launched a luxury brand called Voco in June and is planning an all-suite brand for this year. It's an aggressive and expensive strategy in a market in which room revenue and occupancy rates have softened further still since it took this route. Like-for-like group revenue per available room, or RevPAR, the industry's favoured performance measure, was up 0.3% compared with an increase of 3.5% for the same 3 months last year. Occupancy rates were down 0.2%. Industry analysts have been warning of a slowdown in InterContinental's core US market for some time now. In February, Morgan Stanley said overall US RevPAR was set to slow from an annual growth rate of 3% between 2016 and 2018 to 1.4% this year, driven, it said, by a more challenging corporate demand environment. According to InterContinental's figures, US RevPAR was 0.8% in the first quarter. The hotels group is heavily reliant on the US market. Nearly 2/3 of its rooms are there. About a quarter are in Europe, the Middle East and Africa, and the rest are in China. Investors who've seen the shares rise to their current peak, just shy of £56, have been richly rewarded. They will no doubt want to hear more about InterContinental's plans to expand its reach in Asia and target what it's dubbed the highest opportunity segments. Finally on Friday, it's the turn of bookmakers and betting firm William Hill. Maybe William Hill's shareholders are the betting kind, or simply made of sterner stuff than the average investor, but news that it plans to close about 700 betting shops with the loss of around 4,500 jobs barely touched the share price. The firm said the closures have been prompted by the government's decision to reduce the maximum stake to £2 on fixed odds betting terminals, electronic slot machines that let players bet on the outcome of various simulated games and events. Since April, when it came into force, the company says it's seen a significant fall in revenue from these machines. The knock-on effect of the government ruling isn't new news, though. Back in March, at the time of its annual report, the betting shop chain forecast the government's decision would have a significant negative impact on revenues and could lead to the closure of as many as 900 stores. William Hill currently has 2,300 shops and 12,500 employees and has said the 700 closures could begin before the end of the year. Of course, William Hill isn't the only bookmaker having to make cuts to its shops and workforce. GVC, which owns Ladbrokes Coral and is the UK's largest high street bookmaker, has said it expects to shut about 1,000 shops, while Betfred has earmarked up to 500 for closure. And also, of course, the declining profitability of their stores is only one of these companies' worries. Another related and pressing issue is how to tackle the issue of addiction and problem gambling. What William Hill & Co don't want, though, is more legislation forced upon the industry. So in an attempt to avoid that, William Hill and 4 other gambling companies recently announced measures to improve their safer gambling policies, including a tenfold increase in contributions to a voluntary levy that helps fund treatment for problem gamblers. As UK bookmakers face greater regulation at home, many have also turned to the US, where sports betting was legalised at a federal level last May. While that could mean more competition worries there, as UK bookies tap into the US, William Hill is in something of a unique position for now. It's the only UK gambling company to operate in all 8 states that have active sports betting markets. Broker Deutsche Bank rates the shares a buy and has set its price target at 197p. Stifel has initiated coverage with a buy rating and a price target of 175p. And that's it for this week. To read more on those companies as they report in the week ahead, go to the Markets and Insights section at fidelity.co.uk. See you next time.